Welcome to Jeff's World, everyone, the weekly 30-minute show where our goal is to help you make more informed investment decisions. We're going to cover some key opportunities and risks for investors tied to developments around the world, as we do every week. And we take your live questions from the chat on YouTube. You can ask us what's on your mind at any time by entering it in the chat, and we'll get to those questions in a few minutes after we share some of our latest insights. Now, we've got a lot to cover. But before we get started, we've got some required disclosures before we go. We don't know you personally, I should say, so we don't make personalized recommendations, but we do talk generally about the markets and the sectors and the areas of investing we think are likely to perform well or poorly and why, though we don't provide an outlet for specific stocks. And things can and do change, so all our thoughts we share are subject to change as well. And of course, investing has risks, and international investing has unique risks like currency moves. So please keep all that in mind today. Now, as is the case every week, I'm joined by Michelle Gibley and Heather O'Leary on the global strategy team here at Charles Schwab. Good morning.
Good morning, Jeff. Good morning, everybody.
Good morning, everybody. As typical, I do watch the chat, so please go ahead and submit your questions throughout the show, and we will get to those in a little bit. Jeff, what's on your mind this week?
Yeah, well, as we kick off the week, we've got U.S. reporting inflation data. We've got key updates on China's economy and earnings season arriving in a big way with major Wall Street bank earnings. So on Wednesday, the U.S. is going to report CPI inflation for December and may again show that reports of inflation's death are exaggerated. Economists expect U.S. CPI to rise for the third month in a row, from 2.7 in the prior month to 2.9%. Now, the minutes of the December Fed meeting indicated it's not just the stubborn rebound in the pace of inflation. Another reason Fed policymakers have become less or more hawkish, less prone to cutting rates this year, is that they're factoring assumptions in about the incoming Trump administration's tariff, deportation, and fiscal policies into their baseline outlook. Kathy Jones, our chief fixed income strategist, is saying we may not get any Fed rate cuts this year. So we'll certainly see how the Wednesday data influences that outlook. Now, the earnings season, as I mentioned, is kicking into full gear on Wednesday. We've got reports from the financial sector. Always early reporters are the banks, this time including JP Morgan, Wells Fargo, Citigroup, Goldman Sachs on Wednesday, and then Bank of America and Morgan Stanley on Thursday. Analysts expect them to show continued gains from trading and investment banking. We have seen a recovery in M&A and IPO activity in the fourth quarter, and that helped offset negative interest income declines caused by higher deposits and sluggish loan demand. Now, business leaders are likely to be asked about the 2025 outlook, not just about the quarter that has passed, because we've got, of course, Friday's jobs report that signaled that the Fed may make maybe no rate cuts this year, and that could stunt future profit growth for those enterprises. So we'll hear what they have to say. On Friday, China's going to report GDP, property prices, retail sales, and industrial production for December. That's the last update we're going to get for this data until mid-March. China's economic data often gets smushed together for January and February and not released until March, because we get that week-long Lunar New Year holiday, which sees often a manufacturing shutdown at the end of January and overlapped into the early part of February, combined with a big surge in tourist activity and consumer spending. And it distorts all the January and February data, especially because that Lunar New Year holiday kind of shifts a little bit from year to year. So they end up not reporting January data. They wait till they get February's, and they report them in mid-March. So you can get some wide swings in that data and a lot of speculation around what it might look like. And we're getting some data maybe on Friday that China's housing market may be starting to see some signs of stabilization. So we'll watch that very carefully. And then sticking with the inflation data, I'll just bring out this chart again that I came up with many years ago, and I continue to update periodically. It begs the question, is inflation set to repeat the path of the Jimmy Carter administration from January of 77 to January of 81? I know with the many retrospectives on the Carter administration last week, it's just maybe worth looking at this one more time. I keep updating. It is uncanny how inflation this cycle in orange tracks inflation throughout the 1970s in blue. And it suggests we're at a turning point. As I mentioned, Wednesday, we're going to get maybe a third month in a row of rising inflation. So could we be seeing the beginning of a very stark and dramatic rise in inflation. Everyone's got their view about what caused the pandemic inflation surge. And how much of it was boosted demand from stimulus versus constrained supplies from production shutdowns. A pandemic wasn't the cause of the inflation spike in the 1970s, of course, so it's different this time. And it just may be a coincidence that inflation's closely tracking its 1970s path. And maybe we decouple from the ever higher surge in inflation in the late 70s. But going forward, there are some parallels to the late 70s that are worth thinking about. If we just set aside tight labor markets, yes, they're tight again, they were tight back then, and union pay increases we're seeing now, like we saw back then, tariffs and other factors, it was really geopolitics that drove inflation in the 1970s. The Iranian Revolution of 1978 and 79 damaged the Iranian oil industry, and that led to a loss of output and a big rise in oil prices and global inflation. Could that repeat this time? Now, there are some eerie similarities. Iran is suffering from military defeats, right? Their attempts to build a green wall linking Beirut to Tehran through Syria have collapsed. They've got an energy crisis. In fact, industry in Iran is having to shut down, and heating is being turned off here midwinter because of energy shortages. We've got high inflation. CPI recently hit 40% in Iran. That's been excessively high for years now, and that combines with a very young and disenfranchised population. In fact, almost 40% of Iranians are under 30 years old. All of that would seem to be ingredients for another regime change. Now, I'm not a geopolitical strategist, but it's important to keep in mind potential risks that could further push up inflation since they'd be unwelcome by the market. So we'll have to keep an eye on developments there and what they could mean for oil prices in any echo of the late 1970s. Now, speaking of all that, Michelle, what's the latest on the port strike? This is another potential contributor to inflation. It looks like it was averted, shifting maybe short-term supply risks to long-term port efficiency risk. What's going on there?
Yeah, it looks like there's a deal between the union and the USMX. It's a tentative agreement on a new 6-year deal. The use of automation was a sticking point. Now, we don't have really the details of the new contract, but there is expected to have been some kind of compromise with regard to the use of automation. Container handling for now will continue under the current contract, and the new agreement won't be ratified by members until the summer or fall. We saw an increase in freight rates recently, kind of in advance, kind of in anticipation of potential strike, and that was due to importers pulling forward deliveries. So we might see an ebbing in rates, although rates are always a little volatile this time of year.
Yeah, for sure. There's no shortage of things that could potentially impact those shipping rates. We know there's obviously issues in the Red Sea that are still going on and other factors as well. But yeah, we've definitely got some thoughts here about rising interest rates potentially tied to inflation. We've got government bond yields rising nearly everywhere you look, and not just in the US. UK government bond yields rose to the levels not seen since 1998, even above those levels that surrounded conservative Prime Minister Liz Truss's mini budget that included unfunded tax cuts back in 2022. Big spike in yields. Talk about a crisis back then. This time it looks like the Labour government's unfunded spending plans are pushing bond yields higher. Michelle, are bond vigilantes imposing budget discipline on the UK once again?
Yeah, this really is a global phenomenon. Rates are rising around the world. And there's just a large amount of government bond issuance, and buyers want more yield. They're demanding more yield and restraint on fiscal spending. This chart is the 10-year government bond yield for the UK. And as you mentioned, the 30-year for the UK, which we don't have a chart here, but that was the one that really went up to the 1998 levels. If we're talking about the UK, its economy has struggled in recent quarters. Inflation's still a problem. Sound familiar? A rise in the payroll tax this year could result in businesses passing through at least some of the higher cost to end customers. The Bank of England has been doing QT, so they've been selling bonds. And they might need to stop selling bonds to reduce the pressure on the bond market. and the government may need to reduce spending or raise taxes, and both of those are unpopular. So it was concerning last week that the pound fell despite the increase in yields. Typically, a higher yield would attract more people to buy the pound and then buy the bond, and didn't happen. So it could be that investors are a little concerned about the broader case for investing in the UK. And the UK is almost 15% of the MSCI EFA index. And that's really led by multinational companies such as AstraZeneca and Shell, but they may benefit from a lower pound.
It's interesting you bring all that up because, one of the things about the the currency is, I guess it's all about relative yields, right? And we've seen U.S. yields rise at least as much as U.K. yields. So we talk about, all this big surge in U.K. yields, but U.S. has climbed right along with it. I'm looking this morning, 4.79% on the 10-year. So I think relative to U.S. yields, U.K. yields haven't really moved that much higher. Maybe that's one of the reasons that it's weighed a bit on the currency rather than pushing it higher.
Yeah, that's a good point. And another place where yields have been going up is in France. We've got a new Prime Minister, Bayrou. He's set to unveil a new budget to Parliament tomorrow. He wants to get this passed by mid-February because right now the government is using the 2024 budget. They carried that over in a stopgap measure passed last month to avoid a government shutdown. Last month, Moody's downgraded France's credit rating amid political instability, but French yields really barely moved at that time. Bayrou is an experienced centrist, but he could have issues, the same issues as Barnier in getting a new budget passed, and that includes a divided parliament and the unpopularity of fiscal tightening. There appears to be some move toward negotiation in the days leading up to the budget unveiling tomorrow. Last year, the French fiscal deficit is estimated to have come in at 6.1% of GDP. And that's really far away from the 3% longer-term objective of the EU. Now, French finance minister last week said he was targeting 5.5% deficit in his budget for this year through a set of tax increases and spending cuts.
Yeah, well, we'll see what happens there. It certainly seems like there's less fiscal, I wouldn't even call it austerity, but less fiscal budget tightening on tap for what's going to happen in France. And I'd say the same thing's probably true for Germany, right? So we've got a German election coming up in February 23rd, I think it is. And you've probably got a two-party coalition led by the CDU in Germany, given how they're leading in the polls. And that probably means less spending cuts in Germany as well. So we're looking for, Europe to maybe maintain these wider budget levels. Now, Germany is nowhere near that 3% budget threshold, but still, it's notable that Germany's running budget deficits. They don't usually do that, and they may continue to do that. France's deficits are very wide. Italy, Spain may be doing the same, essentially sustaining these wider budget deficits rather than tightening. That could be relatively good news for economic growth, just meaning less fiscal tightening, maybe a better impetus for growth. But it certainly does raise some questions about the longer-term stability of finances. But of course, in the U.S., we've just brushed all of that aside. So we'll see whether yields can rise beyond those of the U.S. or even widen spreads versus the U.S. Given how much we've seen here. But let's shift over to a closer economy. Let's bring Canada in. Last week's show, we talked about PM Trudeau resigning. It happened during our show, and ahead of this year's Canadian elections. He was hoping, I think, a new face may help his Liberal Party against the Conservatives, which are absolutely crushing them in the polls. I think the Conservatives are currently polling at double the rate of the Liberal Party. So this looks like another government taken down by the inflation surge, like every other incumbent government around the world that got booted out in 2024. What do you think?
Yeah, I think we've got two things here. Fiscal tightening is unpopular and inflation is unpopular. So we've got, yes, as you mentioned, and yet another government, being ensnared by inflation. We had the finance minister, Freeland, step down in December in Canada, and that was over a disagreement with Trudeau, reportedly over the use of government funds in the 2025 budget, as well as her role in trade policy ahead of Trump's term. Trudeau himself has now resigned, but he'll stay in place until a new leader of the Liberal Party can be picked by March 9th. And then any new prime minister is likely to face a national election, maybe as soon as April or as late as October. And another reason that Trudeau is unpopular is that the quality of life for Canadians have fallen in recent years due to, again, high inflation, but also a housing affordability crisis. Home prices and mortgage costs have risen faster than incomes. The leader of the opposition Conservative Party has proposed municipal grants to cities be tied to housing construction and boosting it by 15% a year to increase the supply of housing faster than population growth and therefore, put downward pressure on prices.
Yeah, this is an interesting thing, Michelle, because Canada's seen a massive surge in immigration. Just absolutely huge amounts of immigration coming in. It really has put pressure on housing and a lot of other factors within Canada. It's a big part of this election. It's one of the reasons why Pierre Poilievre, the leader of the Conservatives, who looks like he's likely to be the new prime minister, is really focusing on home prices. But he's also a Trump-like figure. And, you look at Canada and the US and the threats of tariffs and the relationship there, which has really soured, particularly over the last year. And as you note, one of the reasons why there's been some replacements there in Trudeau's staff. That could warm up a little bit if we get to a Canadian election, perhaps this summer, which sees a more Trump-like figure take a position there and address some of these concerns over housing, inflation, and the trade relationship with the U.S. So very interesting to see how that'll shape up in the coming months.
Yeah, I would. We don't have a chart of the Canadian government bond yields, but they've been pretty stable, and the decline in the Canadian dollar has really hurt purchasing power. I would note Canada is not in the MSCI EAFE index, but it is the third largest country weight in the FTSE Developed ex-US index. It's 9%. But Canada overall kind of acts like a financials ETF, due in part to its 37% weight in the sector. So that's something to watch there. What's happening in advanced economies maybe stands in contrast to what's happening in emerging markets, particularly Brazil. Brazil is the largest weight in the FTSE Latin American index. It's 60%, and it's also 4% of the MSCI EM index. And when I looked this up the other day, 4% of the EM index, that was really kind of a surprise to me. It's no longer in the top four. It used to be 16% back in 2011. Wow. So stocks in Brazil have really been weighed down by this self-reinforcing negative feedback loop between fiscal policy and monetary policy. Now, the budget deficit there, Lula has been running a budget deficit close to 10% of GDP. He's unveiled some measures to cut back spending, but there's a concern about their willingness to follow through. Additionally, the weak currency and persistently high inflation has actually caused Brazil's central bank to reverse course. They were one of the early central banks to cut rates, and now they've started hiking rates. They started in September with an increase in another 100 basis points in December, expected to raise rates again in January by another 100 in March.
Yeah, I think inflation is back up to nearly 5%. And I think it got down to near 3, which is pretty low for Brazil. It creeped back up to 4.7, 4.9% or something like that. So it's been on the rise for a year now. And these are some aggressive rate hikes to try and contain it.
Yeah, and rate hikes are likely to cause the economy to slow.
Right.
So it's kind of a bad feedback cycle that they're in right now. And, the currency weakness also cuts into returns for U.S. investors. And the way to get out of this spiral is to end this unsustainable fiscal spending that they're doing. But with elections coming up next year, it's unclear if Lula will actually have the willingness to cut back on government spending.
This is one of the problems with emerging market investing that we always talk about, Michelle and Heather as well. There's such different economies. China's doing one thing, India's doing another thing, Brazil, which has shrunk in terms of its influence. But at one time, Brazil was the largest weight in the emerging market index, if you go back to when it was created in the late 80s. So it's an important component, but, so driven by commodities and then driven by its own domestic issues and currency moves that it really becomes difficult to talk about emerging markets in general. You almost have to talk about regions regions or sometimes individual countries. And that's why, we've been focused on China lately because it remains the biggest weight, but India is becoming increasingly important in that index. Things are going well in India, but those stocks are expensive. So you've got Brazil, where things are just really looking poorly, inflation soaring. China, where things are slowing down and inflation's headed to deflation, and then India, where you've got sort of the best of all worlds. So it's a really unique environment for emerging market stock, making for somewhat of a volatile ride, I think, this year, particularly as we see maybe some signs of stabilization in China. All right, great talk. Let's get to the Q&A, Heather. What questions do we have coming in?
Well, we have just a couple of questions, but first I'd like to remind our audience that we do have a survey showing up in the chat. So please go ahead and click on that link and provide our feedback.
Let me just reinforce that for a second, Heather, and just say we really do value this. We look at it very carefully to make sure we're hitting the mark for you. We want to make sure we're adding value for you on this show, talking about things that are important, answering your questions, what's on your mind. So definitely let us know if you find the show valuable. Let us know if there's things that we could improve on, do a little better. Let us know as well. Thanks.
Absolutely, Jeff. Our first question actually was about India, and I know you touched on it briefly. Can you give us a little bit more details about what's going on in that part of the world?
Yeah, I mean, I'll let Michelle chime in on this as well. She follows India very, very carefully. India, just in a nutshell, things have gone really well for India economically, politically, socially. They've done a lot to clear a lot of infrastructure hurdles. They've grown their manufacturing sector, the economy. It is a unique emerging market economy in that it's way more services oriented than manufacturing. Usually we think of EM countries as exporters of cheap goods or commodities, and India is not that. High value added services. And so very interesting to see how its economy has evolved. But it's very expensive. Historically, India trades at a premium to most emerging market countries because it's less economically sensitive, because it's more services than manufacturing based. But it's very expensive now. I haven't looked at the PE in a month or two, but I think it was 24 times earnings last time I saw it. So should anything begin to go wrong in India, any kind of stumble, you could see stocks pull back quite sharply. I don't necessarily see that. I think things continue to go very well for India and its market retaining those high valuations, but it is a hurdle to further strong performance when you've got valuations quite that high. Michelle, what do you see going on with India right now?
Yeah, India actually might be a potential beneficiary of a Trump 2.0 trade war if more manufacturing moves to India from China. And maybe another thing that's interesting is that India has a really high tariff rate on imports. And so they could actually use a trade war to reduce tariffs on their imports from the rest of the world. And a 1 percentage point decrease in its tariffs on imports from other countries could actually raise its GDP by 0.5%. It has increased in terms of influence on the MSCI EM index. But the stocks there have come off of the highs due to a stronger dollar, also a capital gains tax that was enacted. But they are still pretty expensive. They're 22 times forward, and that's relative to about 10 times for China. So that's interesting.
It is. Well, what an outlier India is. You make just a great point about how protectionist India has been in the past and how it might be moving the other direction, kind of bucking the trend of the rest of the world. Really interesting stuff. And India benefiting from cheap energy prices because they're willing to buy it from some of the pariahs of the world that the Western world isn't. At the same time, it's very malleable on its foreign policy. It's willing to work with the U.S. on some things, Russia on other things, China, maybe not so much China, but you know what I mean. They're sort of flexible on their political front, and that allows them to adapt to changing political conditions pretty well. So very interesting to see how India may navigate all of this. Still one of our favorite emerging markets, despite maybe some of the performance challenges here lately on the weaker rupee. Thanks, Heather. What's next?
Well, what's next? I guess we can talk about changing political climates, both in developed and emerging markets. Do we expect this shift that we're seeing turn around fiscal spending, maybe decreasing deficits around the world, and how might that affect the markets?
There's a lot of talk about, overspending and reining that in, whether it's on, Doge-related things here in the U.S. or trying to create greater government efficiency. If you're talking about maybe less spending on immigration costs in Germany or other places like that, there is some talk about it. But the reality is, as we talked about earlier in the show, budgets are widening everywhere, or at least remaining wide everywhere, overspending tax collections in nearly every country, even those that don't traditionally do so. So, I think we're in an environment where the amount of debt is going to continue to grow, and increasingly rates are starting to show that maybe that's a risk. With the interest rates climbing, mortgage rates in the U.S. now over 7%, maybe that becomes a bit of a challenge to pushing those budget deficits ever higher. But it certainly doesn't appear to be that fiscal discipline is taking root anywhere around the world. Maybe there's some exceptions, Argentina, for example, maybe a few, but for the most part, spending continues to exceed tax collections, and I don't see that changing here in 2025.
Thanks so much, Jeff, for that. One final question, I guess. We have a question about the low rates in the People's Bank of China. Now the question is, are they going to export deflation, much like the question prior about inflation, to the US and worldwide?
Michelle, why don't you take that one?
Yeah, it's interesting what's happening in China. They're really trying to focus on reducing capital flight, and also the low bond yields there is a concern for them, and so the People's Bank of China has decided to no longer buy or no longer sell the bonds. So it's they're kind of in this tough situation where they're trying to control monetary policy and the currency and without really being market based, and not having a market based monetary system is hurting them, I think. In terms of exporting deflation, I mean, we'll see. Certainly, they have a deflationary problem that's mostly because of lack of demand from their consumers. And so that's maybe less influenced by what's happening in terms of exports. Jeff, I think maybe you have some thoughts on that as well.
I think that's well said. I think that's the way to think about it, and it really comes down to domestic issues. And we focus so much on China and its exports, but China's exports to the U.S. are only about 3% of its GDP, and so it's really about domestic concerns and domestic growth and domestic consumer demand that's really going to drive the outlook for inflation there, and then what that means for the rest of the world. Really core to the property market in China, and very tentative signs of any kind of stabilization there as of yet.
Thanks so much, Jeff. I think we have time for one final question. Regarding the tariff situation, and if businesses decide to move their production from China to elsewhere in the world, do we expect demand to shift as well? You mentioned only 3% exports here to the US. How might that be different?
Well, I just point out that we just hit an all-time high in terms of U.S. imports from China. So despite the tariffs that have been put in place and all the other concerns about onshoring and friendshoring, we're still importing more than ever from China. Now, maybe that was a little bit of a surge lately here related to the potential for tariffs, but the truth is we really haven't pulled back dramatically. We'll have to see what happens. I think many manufacturers are looking at diversifying their supply chains, and they have for some time, to creating regional supply chains as opposed to just one that targets China. And we'll see, I think, more diversification around all of that. But I wouldn't expect to see a dramatic, costly shifts in supply chains purely as a result of the new tariffs coming into place. Look, we've been through this before, and we've seen modest shifts for certain product categories, not across the board. But there's a lot we have yet to see. I think we could see large tariffs implemented and then maybe pulled back in favor of negotiations on other issues. Trump appears to be using big tariff numbers as a tool of statecraft rather than economic policy. At least that was true of his first administration. We did see some tariffs, but nowhere near what was initially proposed. And therefore the shifts and impact on sales and operations of multinational businesses may be more muted. But it's a great question. We just really don't know the answer to that yet, but we're going to be watching it closely. Thanks for all those questions. And thanks, Heather and Michelle, and our producers, Andrew and Gabe, and everyone for the questions and for joining us. Be sure to tune in each week at 11 a.m. Eastern or catch the replay on YouTube. And be sure to click like on the show and share your comments on what you're watching in the markets. And we'll see you again next week.